The Bank of Canada just made its decision, and the number is 2.25%, unchanged. No cut, no hike, a deliberate hold. And in a moment where Canadians are navigating rising costs, a cooling housing market, and global uncertainty, a hold is not a neutral event. It is a message. Today we decode exactly what that message is, and what it means for your wallet. The overnight rate is the interest rate at which major Canadian banks lend money to each other, for a single night. It sounds arcane, but it is the single most powerful lever the Bank of Canada pulls to influence the entire economy. When it moves this rate, everything downstream moves with it, the prime rate at your bank, variable mortgage rates, lines of credit, and eventually even fixed mortgage pricing through its effect on bond markets. Understanding this one number unlocks how monetary policy actually touches your daily life. The Bank of Canada did not announce just one number today, it announced three. The overnight target rate sits at 2.25%. The bank rate, which is the rate at which the bank lends directly to financial institutions, sits slightly higher at 2.5%. And the deposit rate, the rate the bank pays on deposits it holds from commercial banks, sits at 2.20%. Together, these three numbers form the corridor that anchors short-term borrowing costs across the entire Canadian financial system. A hold is never passive, it is an active decision to leave conditions exactly where they are. The Bank of Canada has a dual mandate: keep inflation close to its 2% target, and support maximum sustainable employment. When the bank holds, it is signaling that, in its current assessment, the existing rate level is roughly appropriate for where the economy stands. This kind of decision typically reflects a balance between inflation that may still be above target and an economy showing enough signs of softness that further rate hikes could cause unnecessary damage. If you hold a variable rate mortgage in Canada, your rate is almost always priced as prime plus or minus a spread, and prime moves directly with the overnight rate. With the rate held at 2.25%, there is no immediate change to your monthly payment. That is genuine relief for hundreds of thousands of Canadians who have already absorbed significant payment increases since the hiking cycle began. But a hold is not a cut, your payment does not go down today. The question to watch is when, and by how much, cuts might eventually arrive. Here is where many Canadians get confused. Fixed mortgage rates are not set by the Bank of Canada, they are driven by the bond market, specifically Government of Canada 5-year bond yields. The overnight rate influences bond markets indirectly, through expectations about future rate moves. If the market believes the Bank of Canada is done hiking and will begin cutting, bond yields tend to fall, which eventually pulls fixed mortgage rates lower. A hold today, if it signals the end of the tightening cycle, could quietly support the downward drift in fixed rates over the months ahead. While borrowers have largely felt the pain of this rate cycle, savers have quietly benefited. High-interest savings accounts, GICs, and money market products have offered returns that were essentially non-existent just a few years ago. With the overnight rate held at 2.25% and the deposit rate at 2.20%, those elevated savings yields are not going anywhere today. Canadians who have been parking cash in short-term instruments continue to earn meaningful returns, a dynamic that could shift meaningfully the moment the bank begins cutting. Central banks do not hold rates in a vacuum. A decision to maintain the current level typically reflects a view that economic growth is running at a pace that neither requires more stimulus nor demands more restraint. For the Canadian labor market, this kind of signal matters. It suggests the bank does not yet see enough deterioration in jobs or growth to justify an emergency cut, but also does not see enough heat to justify another hike. It is a calibrated posture, watchful, not reactive. Canadian housing markets are acutely sensitive to rate expectations. A hold at 2.25% removes one source of upward pressure on borrowing costs, but it does not inject the kind of rate relief that would dramatically re-energize buyer demand. Markets that have cooled tend to stay in a holding pattern themselves when the central bank holds, neither collapsing further nor bouncing sharply. The real catalyst for housing will be the first confirmed cut in the overnight rate, which this decision does not deliver but also does not rule out. Canada's big six banks, Royal Bank, TD, Scotiabank, BMO, CIBC, and National Bank, will not change their prime rates today. Prime typically moves in lockstep with the overnight rate, so a hold means prime stays put. What banks will do is watch closely for forward guidance language in the Bank of Canada statement, parsing every phrase for signals about the timing of future cuts. Their lending desks, their treasury operations, and their communications to clients are all calibrated around where they think this rate goes next, and so should yours. there are three things worth watching closely in the weeks ahead. First, the Bank of Canada's own forward guidance language. Small shifts in wording can signal big shifts in direction. Second, Canada's inflation data. If the consumer price index continues to drift toward the 2% target, the case for rate cuts strengthens. Third, employment numbers. A meaningful softening in Canadian jobs data would raise the probability of the bank moving from a hold to an active cutting cycle. These three data points will shape every future rate decision this year. Today's hold at 2.25% is the Bank of Canada telling the economy, we are watching, we are not done, but we are not moving yet. For everyday Canadians, that means a moment of stability in an uncertain cycle, no new pain for borrowers, no new erosion of savings yields, and a housing market still waiting for a clearer signal. The next decision will matter enormously. Stay close to this channel for deep, clear analysis every time the Bank of Canada speaks, and if this kind of breakdown is useful to you, subscribing ensures you never miss it.